Welcome to the debate. Imagine checking your credit report, one morning, and finding out you owe thousands of dollars for medical supplies you never bought.
Yeah, the classic identity theft nightmare.
Right. So you go to the financial platform that issued the loan, you dispute it, and they reject your claim. But when you look closely at the evidence they used to deny you, you realize the verified email address on the fraudulent account doesn't belong to the fraudster.
Oh, no.
It belongs to the state investigator assigned by the government to help you fight the case.
Which sounds like a glitch in the matrix, honestly.
Really does. But in the rapidly expanding world of alternative consumer credit, specifically the buy now, pay later sector, this is the reality we are looking at. Today, we are conducting a formal intellectual cross-examination of the BNPL giant, Sezzle.
We're going to be looking really closely at its regulatory compliance, its risk management architecture, and its corporate governance.
Because the central question here is whether Sezzle's explosive growth actually represents a genuinely innovative model. Does it expand financial inclusion for people with thin credit files?
Or is it heavily reliant on regulatory arbitrage, flawed authentication, and high-risk lending practices that mask a deeply unstable operation?
I will be arguing that Sezzle is a fundamentally sound, disruptive financial technology company. Their proprietary risk scoring is a necessary evolution that safely expands access to credit for people locked out of the traditional system.
And my position is that Sezzle's structural bypass of standard credit practices, when combined with severe vulnerabilities in how they authenticate their users, while it reveals a highly precarious lending operation.
Even with the friction they're experiencing, that's simply the standard adjustment period for a rapidly scaling business navigating complex state and federal regulations.
I don't buy the standard adjustment defense. When you look at the alarming red flags at the very top of their corporate governance, you see a system that is actively avoiding collapse through regulatory loopholes rather than genuine innovation.
Well, let's start with the financials, because listeners looking at Sezzle's balance sheet right now might be screaming at their phones saying, the numbers don't lie, the business is booming. And they would be right.
Paper profitability is a very real phenomenon, though.
But it's not just paper. Sezzle is currently seeing 71% year-over-year revenue growth. They are yielding a 37.9% net margin. That kind of profitability doesn't happen by accident.
It happens when you take on massive risk.
It happens because their proprietary risk scoring system, which they call Profit, actually works. For decades, traditional banking has relied on the FICO score, which inherently punishes consumers for not having a history of debt.
Right, but FICO is a proven metric.
It's an archaic model. If you are one of the 2.7 million active consumers on Sezzle's platform who are young, or immigrants, or just operate in cash, FICO locks you out entirely.
Okay, but Profit
replaces that by utilizing device telemetry, behavioral signals, and alternative data to safely underwrite that demographic. And crucially, they are maintaining provisions for credit losses squarely within target guidance.
we really have to ask what is generating that equity and that growth. Because the mechanism behind those numbers, it's where the danger lies. That paper profitability you just laid out, it's built on a foundation of incredibly expensive capital.
All non-bank lenders have a cost of capital.
Sure, but Sezzle is borrowing money from institutional lenders like Bastion Management at an effective interest rate of 12.65%.
Which is high, certainly, but not unheard of for a fintech.
It's not just high, it dictates their entire business model. If your own cost of capital is nearing 13%, you cannot survive mathematically by lending to safe, prime consumers. The math physically forces you into a specific corner.
You're saying it forces them to take on bad loans?
Yes, you have to scrape for high-risk, high-yield subprime borrowers just to make a spread. The risk isn't a byproduct of their mission to help the underbanked. It's a structural requirement of their debt.
I disagree with the premise that 13% forces them into reckless underwriting. Let's look at how Profit actually functions mechanically. The system grades users into A, B, or C tiers based on alternative data.
And that C tier is a disaster area.
Well, alternative data requires a wider funnel to train the algorithm. FICO is a 30-year-old static model, but Profit is dynamic. It needs data to learn.
Exactly. So let's talk about that C tier. Sezzle explicitly stated to their investors that they decided to, quote, open the funnel to take on more risk. And what was the mechanical result of that decision?
They expanded their user base.
Their C-rated loans, the absolute highest risk tier on their platform, grew by 22% in a single quarter. C-rated loans now make up 29% of their entire portfolio. And the consequence of taking on that much risk is pretty stark. Notes past due between 1 and 90 days have spiked 90%, hitting $25 million.
Let me push back on that framing, because dropping a raw number like $25 million past due sounds terrifying until you explain what gross merchandise volume, or GMV, actually is.
It's the total volume of goods sold.
Right. GMV is the total dollar amount of goods sold through the platform. Sezzle's provision for credit losses is $13.7 million, which represents just 1.2% of their GMV.
But the spike...
Their forward guidance told the market to expect losses between 2.5% and 3.0%. So structurally, the losses you are pointing to are completely calculated and heavily provisioned for.
I understand the argument that it's a learning curve for the algorithm, but that defense completely ignores how this risk physically manifests for the consumer.
Meaning what?
When you open the funnel to high-risk populations, you become an incredibly lucrative target for fraudsters. We need to look at the mechanics of their authentication architecture, specifically what cybersecurity experts call the decoupling vulnerability.
You are talking about the friction during user onboarding and identity verification.
It is far worse than friction. Let's explain the mechanism of how a bad actor exploits Sezzle. The system allows a fraudster to establish an account using stolen personally identifiable information.
So using a victim's actual social security number.
Right. Real SSN, real name, real date of birth. But the vulnerability is that Sezzle's architecture allows the fraudster to link that stolen identity to a completely unauthorized third-party email address and burner phone number.
Right, so the underlying identity belongs to the victim, but the contact nodes belong to the fraudster.
Exactly. Their authentication flow is like a bank letting you open a safety deposit box using someone else's ID, but letting you put your own personal padlock on the outside of it. The victim technically owns the box, but only the fraudster has the keys.
Well, Sezzle utilizes biometric registration and multi-factor authentication during account creation.
But that MFA goes to the fraudster. Sezzle's system doesn't sufficiently cross-verify that the email address actually belongs to the owner of the Social Security number. So when they send MFA codes, billing statements, or collection notices, they all go straight to the fraudster's inbox.
And the actual victim has no idea this credit line exists until it hits their credit report.
Exactly. And the mechanism of how Sezzle handles dispute resolution makes it a nightmare to fix. When the victim finally pulls their credit report, sees a delinquent account, and tries to contact Sezzle to resolve it, they are locked out.
Because of the in-app chat.
Right. Sezzle's primary customer support architecture relies on an in-app chat. And to use that chat, you need an active login. If you don't have the login credentials because the fraudster set the email and password, you physically cannot reach the fraud team to report the identity theft.
I hear the structural critique there, but let's contextualize this. Fraudsters are actively targeting Sezzle's subprime base using lookalike top-level domains.
The TLD phishing issue.
Yes, TLDs like .buzz, .shop, .top, and .best. They set up spoofed websites mimicking Sezzle's brand to harvest consumer credentials. That is a phishing campaign. Phishing is a universal, internet-wide cybersecurity problem.
But it disproportionately affects platforms with weak identity verification.
It affects Chase, it affects Bank of America, it affects everyone. As of early 2026, Sezzle has not suffered a direct, massive database breach of their own internal servers. Are their systems perfect? No, but they meet standard industry compliance for a payment provider. You are demanding they act as a cybersecurity firm policing the entire internet's phishing problem.
I am not asking them to police the internet. I am asking them to validate the evidence they use when their own system is weaponized against a victim. And if we want to talk about how they handle the fallout of authentication failures, we have to talk about the Royer case.
Ah, Dr. Benjamin Royer?
This is perhaps the most devastating piece of evidence regarding Sezzle's operational and forensic failures.
For the audience, you are referring to the medical identity theft of Dr. Royer following the Open Loop Health data breach.
Yes, 1.6 million patient records were compromised at Open Loop Health. Dr. Royer's identity was stolen, and unauthorized charges for a company called MedV were pushed through Sezzle.
And they were billed to his Capital One account.
Right. And when Royer disputed those charges under the Electronic Fund Transfer Act, Sezzle didn't just passively fail to catch the fraud. They actively fought his dispute. They sent Capital One a 216-page evidence package to legally prove that Royer authorized the transaction.
And this is where the distinction between different types of evidence becomes crucial. In payment processing, you have Leg 1 evidence, which simply proves that the payment processor, Sezzle, paid the merchant.
Right.
Then you have Leg 3 evidence, which is the proof that the consumer actually authorized the bank draft.
Precisely. And when Royer, who refused to back down, conducted a forensic analysis of Sezzle's 216-page package, he found something deeply alarming.
The Apple Preview metadata?
Yes. He discovered that a Sezzle employee, Lauren Doolittle, had batch-applied identical red squares and text annotations using the basic Apple Preview application to fabricate Leg 3 authorization evidence. They took Leg 1 evidence, internal receipts showing Sezzle paid MED slapped, red boxes on it, and passed it off to Capital One as proof that Royer authorized the charge.
I will not defend the conflation of Leg 1 and Leg 3 evidence. That is a serious forensic and administrative failure on the part of the dispute team.
It goes so far beyond an administrative error, though. The metadata in that package exposed what Royer called the trilemma, which I think is the ultimate proof of Sezzle's broken data architecture.
Let's lay out the trilemma.
Sezzle's own internal rebuttal documentation, the very documents they used to deny the fraud claim, show that the verified email address on Royer's Sezzle account was drew.kramer@wisconsin.gov.
Wait, the actual government email address?
Yes. Drew Kramer was the official state investigator for the Wisconsin Department of Agriculture, Trade, and Consumer Protection, who was assigned to investigate Sezzle on Royer's behalf.
Okay, that is undeniably bizarre. The investigator's email got attached to the fraudster's account profile.
Exactly. So Royer pointed out the trilemma. Either one, Dr. Royer committed fraud by somehow using a state investigator's government email to open a Sezzle account.
Which is absurd.
Right. 2, the state investigator used Royer's stolen identity to buy medical goods. Or 3, Sezzle's underlying data architecture fundamentally mismerges data across user profiles and regulatory inquiries.
Meaning the automated system scraped the investigator's email from the inquiry.
They hard-coded into the victim's profile as a verified contact. This renders the entire foundation of evidence they used to deny fraud claims completely invalid.
The trilemma elegantly highlights a highly specific algorithmic data merging flaw. And yes, scraping an investigator's email and applying it to a user profile is a massive operational glitch. But let's look at the actual resolution of that case.
They only resolved it when they were cornered.
But they resolved it. In May 2026, Sezzle ultimately waived Royer's entire balance. They requested trade line deletions across all credit reporting agencies to fix his credit score, and they permanently closed the account.
As a business accommodation.
They classified it as a business accommodation, yes. Doesn't this prove the opposite of your point? It proves that when an issue is escalated, the system ultimately corrects itself. The rapid scaling of any fintech company causes administrative friction, but they honored consumer protection and made the consumer whole.
They made him whole only after he conducted a digital forensic audit of their Apple Preview metadata and cornered them legally. That is not a system correcting itself. That is a corporation avoiding a catastrophic legal precedent by quietly making a massive liability go away.
It's standard dispute resolution at the highest level of escalation.
And we know this isn't an isolated incident because of how their automated systems interact with federal law. Under the Fair Credit Reporting Act, when a victim submits a formal police report or an FTC identity theft affidavit, credit bureaus are required to block that fraudulent information within 4 days.
Right, the standard FTC block.
But Sezzle's automated systems routinely reject those FTC affidavits. Worse, they then issue automated debt certifications to the credit bureaus. These certifications illegally override the credit bureau blocks, forcing the fraudulent debt back onto the victim's credit report.
Which brings us directly to the regulatory framework that governs all of this, and specifically Sezzle's partnership with WebBank. You continually characterize their structure as regulatory arbitrage.
Because it is.
I view it as a completely standard institutional partnership. Sezzle uses WebBank, which is a Utah-chartered industrial bank, to originate their loans. This is the exact mechanism by which almost all major financial technology companies scale nationally. It allows them to operate across state lines without having to physically build a chartered bank from the ground up in all 50 states.
It is the textbook definition of regulatory arbitrage. The mechanism of using a Utah chartered bank is entirely about exporting Utah's lack of interest rate caps. It allows them to bypass consumer protection laws in states with strict usury limits, and they're playing fast and loose with federal law to do it.
How so?
Let's look at the Truth in Lending Disclosures, or TILDs. These are federally required documents under Regulation Z designed to tell a consumer exactly how much they are borrowing. In the Royer audit, they examined 38 different Sezzle and WebBank TILDs. They found that 53% of them overstated the amounts financed.
But let's explain why that happens mechanically. It's not a malicious conspiracy to overcharge consumers.
Malicious or not, it's illegal.
The discrepancy happens because Sezzle's automated system generates a static TILD at the exact moment of checkout, based on the shopping cart total. But sometimes, upon final settlement, days later, the merchant ends up charging less. Maybe an item was out of stock or shipping was cheaper.
But the document doesn't update.
Right. The static PDF document generated at checkout doesn't dynamically update to reflect the lower final settlement.
But under Regulation Z of the Truth in Lending Act, you cannot systemically issue false federal regulatory documents just because your software lacks a dynamic update feature.
I will not sit here and defend inaccurate disclosures, but we have to acknowledge that the regulatory landscape for buy now, pay later is actively evolving as we speak.
Evolving is a polite word for multi-state investigations.
In December 2025, a multi-state coalition of attorneys general launched a massive inquiry into fee transparency and disclosures across the 6 largest BNPL companies. And Sezzle is actively participating in that inquiry. They are operating under state lender licenses where required. What you are calling systemic failure is actually just unprecedented friction.
Friction.
Yes, friction. It is what happens when you plug a highly automated agile tech platform into legacy banking regulations that were written in the 1970s. The old regulations demand static paper trails, but modern technology operates dynamically.
And that modern technology operates dynamically to extract maximum value from the consumer. But if you want to know if a company's internal systems are truly sound, you don't just look at the software. You look at the people running it. Let's look at Sezzle's corporate governance.
Okay.
In April 2026, Karen Webster abruptly resigned from Sezzle's board of directors. And she wasn't just any board member. She served on the Audit and Risk Committee, the Compensation Committee, and the Nominating and Corporate Governance Committee.
People resign from boards.
Her resignation letter wasn't polite PR speak. She explicitly cited a, quote, growing difference in perspective with management concerning the company's direction, key decisions, and governance.
Board rifts happen. When a scrappy startup matures into a heavily regulated public entity, the founders and the institutional board members often clash over the pace of compliance. It is a very natural consequence of scaling.
A resignation from the head of audit and risk that triggers massive securities fraud investigations by firms like Pomerantz and the Shaw law firm is not natural scaling. And you have to look at what the executives are doing while the board fractures. CEO Charlie Youakim pledged 1.72 million shares of his own stock as collateral for a private margin loan.
Again, founder margin loans are a very common mechanism in the tech industry to achieve liquidity.
He pledged roughly 30% of the entire company's outstanding shares, $500 million worth of stock tied up in a personal margin loan. Simultaneously, other insiders and early investors liquidated $71 million in stock.
Which is a valid capital strategy.
Mechanically, if Sezzle's stock price drops, the bank issuing that margin loan can issue a margin call that forces the liquidation of 30% of the company's shares on the open market, which would completely wipe out public shareholders. If the proprietary profit algorithm is so brilliant and the regulatory strategy is so sound, why is the CEO using a third of the company to secure personal cash outside of traditional share sales?
Because dumping 1.72 million shares on the open market would instantly dilute public shareholders and crash the stock price. A margin loan prevents that dilution, and if you want to talk about the actual health of the company, look at institutional confidence.
You mean the credit facility?
Yes. Just recently, Sezzle secured a brand new $300 million credit facility. Institutional lenders do not hand over $300 million to a company that is fundamentally a house of cards. They do rigorous due diligence. They look at the mechanics.
They look at the spread.
They see the 92% return on equity. They see the 52.5% adjusted EBITDA margin, which means their core operating profit before interest and taxes is incredibly strong. Sezzle is navigating administrative friction, yes. It requires aggressive financial maneuvering, but its underlying technology successfully expands access to capital for millions of people who actually need it.
I just simply cannot agree with that conclusion. That $300 million credit facility isn't proof of innovation. It is just more high-cost capital poured into a leaky bucket to keep the volume growing.
It keeps the platform accessible.
Sezzle's entire ecosystem is structurally precarious. They are mathematically forced to underwrite subprime consumers because of their own expensive debt. They rely on an authentication architecture that lets bad actors put their own padlocks on stolen identities, locking out the actual victims. They merge consumer profiles with state investigators in their automated systems, and they actively issue inaccurate federal disclosures.
Well, when the insiders are cashing out and the head of audit and risk is resigning, you are looking at a company avoiding collapse through aggressive debt collection and regulatory loopholes, not genuine innovation.
It is clear we can look at the exact same data and see completely different trajectories here. I see a company whose high margins and revenue growth prove that the profit model works. And while there are undeniable, isolated administrative failures in their dispute resolution, those errors simply do not negate the platform's overall value to the underbanked.
And I see a predatory lending operation that masks its systemic operational fragility with short-term accounting tricks and regulatory evasion.
But what we do absolutely agree on is that the integration of automated buy now, pay later systems with legacy banking regulations creates an unprecedented level of friction.
Oh, completely. The industry desperately needs updated compliance frameworks that actually address dynamic underwriting and the very real realities of digital identity theft.
Exactly. The multi-state investigations into the BNPL sector are going to be fascinating to watch, and there is much more to explore in how federal frameworks will adapt to algorithmic lending. We'll leave it to you, the listener, to draw your own conclusions about whether Sezzle's operations represent the future of accessible credit or if they are a predatory house of cards. But as you do, remember our opening thought. When you look at the financial and regulatory health of this industry, be prepared for the reality to be murky. And always ask yourself, when a dynamic algorithm meets a static regulation, who is really paying the cost of that friction?